Welcome back to the Wealthy Good Life. Um, Today, we are going to be diving deep into the world of banking.
Mm-hmm.
And more specifically,
Right.
you know how they actually make their money.
Right.
Um, and you share some really interesting stuff with me. And,
Yeah.
we're going to be looking at everything from traditional banks to
Yeah.
the newer fintech banks and even some really alternative, unconventional things that people are doing. So, um, our mission today
Yeah.
is to unpack these different approaches,
Yeah.
extract the key takeaways for
Yeah.
you without getting bogged down in jargon.
Great.
So let's just jump right in and start with the fundamentals.
Okay.
How do these traditional banks, the bedrock of our financial system, actually generate these huge
Yeah.
revenues?
Okay. Well, at its heart, the engine of a traditional bank revolves around this very basic concept, customer deposits.
Okay.
And these deposits become the fuel for two primary revenue streams.
Okay.
The first is something called the float, and the second is the generation of credit through loans.
Okay, the float. That's
Yeah.
intriguing.
So imagine this. The Federal Reserve
Okay.
currently pays banks a certain interest rate on the reserves
Yeah.
they hold. And right now, that rate is actually quite significant,
Okay.
hovering around 4.50% or higher.
Okay. Wow.
Now, contrast that with the very minimal interest rates that traditional banks typically offer to their depositors, often just a tiny fraction of a percent,
Yeah.
0.01 to 0.04%.
Right.
So that difference, that substantial gap
Yeah.
between what they earn on your deposits at the Fed and what they pay you,
Yeah.
that is the float. It's a surprisingly large and consistent source of revenue simply from holding customer funds.
Wow. So essentially, banks are profiting immensely from the sheer volume of our deposits
Right.
while doing very little in return for us.
That's right.
It's a fundamental imbalance worth noting.
It is, yeah.
And then, of course, there's the loans. And this feels like the more direct way that they
Well,
make money.
Precisely, banks take a significant portion of those deposited funds and lend them out
Okay.
to borrowers at a higher interest rate than what they pay
Yeah.
to depositors. And this difference between the interest they charge on loans and the interest they
Yeah.
pay on deposits is known as the interest rate spread, and it's a
Right.
primary driver of their profitability.
And the variety of loans that they offer is vast, right? It's not just mortgages.
Oh, yeah, absolutely.
Yeah.
The spectrum of loan products is quite broad.
Yeah.
For individual consumers, you have auto loans to finance vehicles, mortgage loans for property purchases,
Yeah.
student loans to fund education, personal loans for various needs, and the ubiquitous credit cards.
Okay.
On the business side, the offerings are even more diverse,
Wow.
including lines of credit for working capital small business loans to fuel growth,
Yeah.
short-term loans for immediate needs, specialized financing for startups, microloans for smaller ventures, and more sophisticated instruments
Okay.
like venture debt bridge financing and even mezzanine financing.
So they're essentially taking our money, paying us practically nothing, and then lending it out
Right.
at significantly higher rates across all these different sectors.
Yeah.
It's really a clear picture of how that core engine works.
Yeah.
But I've also heard about this term fractional reserve banking.
Okay.
So how does that play into a bank's ability to lend money?
This is where it gets really interesting and where the scale of their lending truly comes into focus.
Yeah.
Fractional reserve banking is a fundamental principle that allows traditional banks to significantly expand the amount of money that they can lend.
Okay.
In many countries, including the U.S., the reserve requirement is around 10%.
Okay.
This means that for every dollar deposited, a bank is only legally obligated to keep 10 cents
In their
in reserve and has the potential to lend out the remaining 90 cents.
90 cents on the dollar. That seems like a very small cushion.
It is, and this is where the system demonstrates its power.
Okay.
Let's say you, being a savvy individual, deposit $500,000 at Bank ABC,
Right.
which operates under this 10% reserve ratio.
Okay.
Bank ABC keeps $50,000 in reserve
Okay.
and lends out the remaining $450,000
Right.
to, say, a local business owner, let's call them Person B,
Yeah.
who uses it to expand their operations.
Yeah.
The money Person B spends then ends up as a deposit in another bank.
Okay.
Let's call this Bank DEF. Now, Bank DEF also operates under the 10% reserve requirement.
Okay.
So they keep $45,000 and can
Yeah.
lend out $405,000.
Wow.
This process continues with that $405,000 potentially being lent out again,
Oh, wow.
eventually being deposited in yet another bank, and so on.
So my initial $500,000 deposit is essentially the foundation for
Yes.
multiple loans circulating throughout the banking system.
Precisely. A single deposit has this cascading effect, creating what some describe as an indefinite supply of new money,
Wow.
circulating as it gets lent and redeposited.
That is mind-blowing.
This ability to leverage a single deposit to facilitate multiple loans is a significant advantage and a key driver of the scale of traditional banks.
So beyond the float and the interest rate spread,
Right.
what other revenue streams contribute to those substantial bank profits?
Traditional banks have a diverse portfolio of revenue generators.
Okay.
One significant area is banking service and product fees.
Okay.
Think about the various charges you might encounter:
Okay.
account maintenance fees, debit card fees, ATM fees, overdraft fees, and so on.
It feels like every time I just need $20, the ATM takes a little cut
Yeah.
convenience
Oh,
fee.
yeah. Yeah.
It adds up.
While any single fee might seem relatively small when you multiply it by the sheer number of customers
Right.
a large bank serves, it aggregates into a substantial and consistent income stream.
And it's interesting to see how neobanks often market themselves
Yes.
as being largely fee-free in direct contrast to this model.
That's a deliberate and key differentiator in their business strategy.
Another significant revenue source for traditional banks is interchange revenue.
Yes.
Every
Right.
time you use your credit or debit card at a merchant,
Right.
the bank charges a small fee to the merchant for processing that transaction.
That's right.
Additionally, banks earn substantial interest on outstanding credit card balances,
Right.
which, as many people know, can be quite a lucrative area.
Yeah.
Traditional banks also often levy fees for more specialized or advanced features and services,
Yeah.
such as expedited bill payment or integrations with accounting software for
Right.
business clients. Again, this contrasts with many neobanks that often include these features
Right.
as part of their standard no-fee offering.
That's right.
And then we move into the more sophisticated realm of investment banking.
Exactly.
How do they generate revenue from this?
Investment banking and trading activities represent another significant, though often more volatile source of income, particularly for the larger traditional banks.
Okay.
This includes listing companies and raising capital through initial public offerings or IPOs,
Okay.
or by connecting them with private equity firms.
Okay.
They also play a crucial role in guiding companies through mergers and acquisitions,
Yeah.
essentially acting as expert advisors and facilitators.
Okay.
Additionally, these banks engage in trading stocks, bonds, and other financial instruments
Okay.
on their own account, and they provide investment advice and wealth management services
Cool.
to clients, all of which generate fees, commissions, and trading profits.
So it's a really broad spectrum of activities.
It is.
From those everyday account fees
Yeah.
to these high-stakes financial deals that generate revenue for traditional banks.
Right.
Now let's pivot and talk about the newer players on the scene.
Okay.
Neobanks and fintech companies.
Right.
How do they generate revenue, especially considering that many of them operate without the traditional banking charter?
Yeah, that's a critical distinction.
Okay.
Many neobanks and fintech companies operate without a full-fledged banking charter,
Okay.
which means they typically cannot directly lend out customer deposits in the same way
Right.
that traditional banks do, leveraging fractional reserve banking. Instead, they often rely on establishing
Yeah.
multi-tranche credit facilities with more established chartered financial institutions.
So essentially they have to borrow money from bigger institutions to lend out.
Yeah.
It's like a smaller business having to get a loan from a larger one to then offer services to its own customers.
Right.
That sounds like it could put them at a disadvantage.
It does.
What are some of the challenges they face compared to traditional banks?
It introduces several key disadvantages. Firstly, their cost of capital is generally higher because they don't have that low-cost, readily available deposit base that
Yes.
traditional banks benefit from. Secondly, their cost of funding tends to be variable, meaning it fluctuates
Yeah.
with changes in the Federal Reserve's benchmark interest rates.
Okay.
This is unlike the more stable cost of funds that traditional banks often have thanks to longer-term deposits.
Okay.
Finally, neobanks without charters need to continuously establish and renew these credit facilities
Okay.
to meet loan demand, whereas traditional banks, as we discussed, have that inherent ability
Right.
to expand lending through the fractional reserve system.
So if they can't lend out deposits directly on the same scale, where does their primary revenue come from?
Okay, so for non-chartered fintechs, the primary revenue sources
Hmm.
are often the float, although it tends to be smaller compared to traditional banks.
Okay.
This is because they frequently offer significantly higher annual percentage yields, or APYs, to
Uh-huh.
depositors. We're often talking around 4.0%,
Okay.
or even higher in many cases as a key strategy
Okay.
to attract those deposits in the first place.
That makes them pretty appealing to consumers.
Yeah.
Um, but how can they afford to pay so much more interest?
One common mechanism they employ is offering what are often termed treasury services
Okay.
or sweeps.
Yeah.
In this model, the fintech company partners with established brokerage firms
Okay.
or asset managers to invest the deposited funds into highly liquid, low-risk
Yeah.
money market funds. These funds typically hold government-backed securities like treasury bills and bonds.
Okay.
The interest earned on these securities is then passed back to the depositors
Okay.
in the form of that higher APY.
Okay.
While this provides a better return for the customer, it also generates some revenue for the fintech company through fees charged by the partner institution
Right.
or a small portion of the yield earned on the invested funds.
So it's a different way of leveraging deposits more through strategic partnerships and investments in very safe assets.
Right.
Now let's circle back to interest rates for a moment.
Sure.
You mentioned the Federal Reserve
Right.
and their role in setting short-term rates. How do these rates ripple through and impact banks, both traditional and newer players?
Interest rates are absolutely fundamental to the profitability and overall health of banks.
Okay.
Central banks like the Federal Reserve in the U.S. utilize short-term interest rates
Yeah.
as a primary tool to manage the broader economy
Yeah.
and keep inflation in check.
Okay.
Long-term interest rates, on the other hand, are generally determined by the market forces
Oh.
of supply and demand for debt.
Okay. And how do these fluctuating interest rates directly affect a bank's bottom line?
Okay, so generally falling interest rates can be quite beneficial for banks.
Okay.
Their cost of funding, particularly what they pay on deposits, tends to decrease,
Okay.
while they can often maintain existing interest rate spreads
Yeah.
on their loan portfolios. Additionally, lower rates can stimulate borrowing activity by both businesses
Yeah.
and individuals, leading to an increase in loan demand.
Okay.
Conversely, rising interest rates can put a squeeze on bank margins. They might face pressure to increase the interest they pay to attract and retain depositors,
Right.
while loan demand could potentially decrease as the cost of borrowing
Yeah, it makes sense.
becomes more expensive.
Higher borrowing costs could lead to more financial strain for borrowers.
Right.
Now let's revisit capital markets and fee-based income.
Sure.
We touched on its importance for traditional banks, but how significant are these areas
Right.
across the broader banking landscape?
They're incredibly significant and represent a crucial diversification of revenue streams.
Okay.
For many financial institutions, capital markets income, as we discussed, is derived from facilitating activities such as
Okay.
the sales and trading of securities, the underwriting of new debt and equity issuances for companies, and providing advisory services on mergers and acquisitions.
Okay.
This income stream is inherently more volatile as it is directly linked to the overall health and level of activity in the financial markets.
Okay.
During periods of strong economic growth and robust deal-making,
Yeah.
this income can be substantial,
Okay.
but it can also decline rapidly during economic downturns or periods of market uncertainty.
So it's a bit of a financial roller coaster.
Yeah. Yeah.
Dependent on broader market conditions.
Yeah.
That's why fee-based income probably holds a particular appeal for banks due to its stability.
Precisely.
Yeah.
Fee-based income offers a much more consistent and predictable stream of revenue.
Okay.
This encompasses a wide range of service charges, including monthly account maintenance fees, overdraft fees, ATM usage fees, credit card annual fees, and fees for investment management services.
Yeah.
What makes this so attractive to banks, particularly during less robust economic periods when lending activity might slow down, is its relative resilience.
Yeah.
People generally still need checking accounts
Yeah.
and utilize ATMs regardless of the broader economic climate.
Yeah, that's true.
It acts as a bit of a buffer when other more cyclical income sources might be less reliable.
So it provides a more stable foundation, regardless of market fluctuations.
Right.
We've been talking about banks broadly, but let's focus specifically on commercial banks.
Okay.
What defines them, and why are they considered such a vital component of the overall economy?
Commercial banks are truly the backbone of our financial system.
Yeah.
At their core, they perform the fundamental function of accepting deposits from individuals and businesses
Yeah.
and offering a wide array of financial products and services to these customers. Their primary source of profit comes from the interest
Okay.
they earn on loans, such as mortgages, auto loans, business loans, and personal loans,
Okay.
which are largely funded by those very customer deposits.
Yeah.
They also, as we've discussed, generate revenue through various service charges and fees.
And we're seeing a growing trend of online-only commercial banks emerging.
Oh, yeah, absolutely.
How has this changed things?
The advancements in internet technology have led to a significant rise in online-only commercial banks. Because they typically have lower overhead costs associated with not maintaining expensive physical branch networks,
Right.
they often have the potential to offer lower fees and a wider array of services to their customer base.
But beyond just serving individual and business customers,
Yeah.
what's their broader significance to the health of the economy?
Commercial banks play a critical role in facilitating the creation of capital credit and liquidity
Okay.
within the market. By taking in deposits and then lending those funds out, they enable the flow of money throughout the economy, which in turn fuels business investment, job creation, and consumer spending, ultimately driving overall economic activity.
Okay.
It's also important to remember that commercial banks operate under significant regulatory oversight, with central banks often setting reserve requirements, as we discussed earlier, and implementing other regulations to ensure the stability and soundness of the financial system.
So they're absolutely central to the functioning of our economy. Now let's explore a really interesting and perhaps less conventional idea.
Okay.
Thinking entirely outside the traditional banking system and the concept of becoming your own bank.
Okay.
Using whole life insurance.
Okay.
This is a concept that I know piques the curiosity of many.
It is. It's a paradigm shift
Yeah.
in how we think about managing our money.
So what's the basic idea behind this approach?
The frustrations that can arise from seeking loans through traditional channels and navigating fluctuating interest rates have led some individuals to explore alternative, more self-directed financial strategies.
Okay.
The concept of utilizing a properly structured whole life insurance policy as your own personal banking system revolves around several unique features.
Like the cash value component.
Exactly.
Yeah.
Within a well-designed whole life insurance policy, a portion of your premium contributions goes towards building cash value, and this cash value grows over time on a tax-deferred basis.
Yeah.
But the truly empowering aspect of the strategy lies in the ability to take out policy loans against that accumulated cash value.
And these policy loans are different from traditional bank loans, right?
Precisely. When you take out a policy loan,
Okay.
you are essentially borrowing against the cash value of your own policy as collateral.
Yep.
Unlike applying for a bank loan, there are typically no credit checks or lengthy and often intrusive approval processes involved.
That's nice.
The life insurance company approves the loan because it is directly secured by your policy's existing cash value.
And the repayment terms are also more flexible.
Yeah, the repayment terms offer significant flexibility. You generally have the autonomy to decide when and how much you want to repay. There aren't usually mandatory repayment schedules or late payment penalties in the traditional sense. However, it's important to emphasize that responsible repayment is still essential for the long-term health and effectiveness of your policy as a personal banking system. Consistent repayment helps to ensure the continued growth and compounding of your cash value.
So how can someone strategically use this becoming your own bank concept to actually build wealth beyond just having access to funds for emergencies?
There are several powerful ways individuals utilize this strategy for wealth accumulation. One common approach is to pay off high-interest consumer debt, such as credit card balances, using a policy loan. Instead of making substantial interest payments to a bank, you are essentially paying interest back to your own policy.
Interesting.
Another effective strategy is to borrow from the policy to invest in appreciating assets like real estate or to provide capital for starting or expanding a business venture. The goal here is to use the returns generated from those investments to repay the policy loan, thereby potentially creating a positive wealth-building cycle where your assets generate income that benefits your personal financial system. People also utilize policy loans to finance significant purchases such as vehicles or home renovations.
Yeah.
Again, keeping the interest payments within their own financial ecosystem rather than going to an external lender.
I feel like there are a lot of misconceptions surrounding whole life insurance.
There are.
What are some of the most prevalent myths that you've come across?
One of the most frequent misconceptions is that whole life insurance is simply too expensive.
Yeah, I've heard that.
While it's true that the initial premium payments are generally higher compared to term life insurance,
Okay.
it's crucial to recognize that you are paying for more than just a death benefit.
Yeah.
The built-in cash value component and the unique ability to leverage it as a personal banking tool adds significant financial utility and potential.
Yeah.
Another common myth is that taking out policy loans will somehow harm or ruin your accumulated cash value.
Okay.
This is generally not the case.
Okay.
While the loan is outstanding, your cash value continues to earn interest, although the crediting rate might be slightly different on the borrowed portion depending on the specific policy terms.
Okay.
The key, as we mentioned before, is responsible and consistent repayment to ensure the policy's continued growth and performance.
And this is not a financial tool that's exclusively for the ultra-wealthy, is it?
It's exactly.
That's another perception that I've encountered.
While it's a strategy that has historically been utilized by affluent individuals and families, it's truly available to anyone who's committed to financial responsibility and is seeking greater control and flexibility in managing their money. It does require discipline in terms of consistent premium payments and responsible loan repayment, but it is certainly not limited to the super rich. It's more about adopting a mindset of proactive financial control and long-term strategic planning.
This is really interesting. It's just an alternative perspective on personal finance. Now let's shift gears one final time and explore another strategy. That can be really powerful. Leveraging business credit and the relationships that you can build with banks. Specifically in the context of real estate investing. So tell me about that.
The business world truly operates on business credit. Yet it's a topic that's often conspicuously absent from traditional personal finance education. Cultivating a strong business credit profile can be a game changer for real estate investors, particularly those who may have faced challenges for their personal credit history in the past.
So it's about establishing a financial identity for your business separate from your personal finances.
The initial and often crucial step involves establishing a legitimate business entity, whether it's a sole proprietorship, an LLC, or a corporation, and obtaining a unique tax identification number, an EIN, from the IRS. This EIN allows you to begin building a credit history specifically for your business, entirely separate from your personal credit report.
So banks often solicit business credit cards and lines of credit to their business account holders.
Yes, they do. You might even recall experiencing this yourself.
I think I have.
Being offered a business credit card shortly after opening a business bank account.
Yeah, I always assumed it was just another way to encourage more spending.
It certainly can be if not managed strategically.
And potential debt.
However, the prudent and strategic use of business lines of credit can be incredibly powerful for acquiring assets essential for your real estate business, even if your personal credit score isn't currently where you'd like it to be. There are numerous real-world examples of individuals being able to secure financing for crucial business assets, such as work vehicles or equipment, through their established business credit line when their personal credit alone would not have qualified them for such financing.
That's a huge advantage for entrepreneurs who might be rebuilding their personal credit.
And the power of having access to revolving business lines of credit for funding real estate investments, particularly for short-term projects, is immense. You can draw upon the credit line to finance the acquisition and renovation of a property, for example, and then repay the line of credit once the property is sold or refinanced, generating a profit in the process. Consider a real estate investor who utilizes a business line of credit to quickly renovate a distressed property over a 6-week period and then sells it for a significant profit.
So banks are willing to lend to businesses based on their own creditworthiness.
Yes, particularly if the business itself demonstrates consistent profitability, sound financial management, and strong underwriting fundamentals. Yeah. When we talk about underwriting, we mean the process banks use to assess the risk of lending to a particular borrower, looking at factors like cash flow, revenue business plan, and existing debt obligations. Yeah. Banks are fundamentally in the business of lending money, and they are willing to lend to entities that they believe have a high likelihood of repaying the debt according to the agreed-upon terms.
So it really comes down to understanding how banks underwrite business deals and structuring your business and investment deals in a way that aligns with their lending criteria.
Exactly.
And demonstrates a low level of risk.
Right.
This has been such a comprehensive exploration into the world.
It has.
Of how banks make money and some really fascinating alternative financial strategies.
We've certainly covered a lot of ground, providing you with a much clearer understanding of the diverse ways that financial institutions, both traditional and innovative, generate revenue. Yeah. From the often unseen mechanisms of the float and fractional reserve lending to the more apparent fee-based income and the complex dynamics of capital markets. Yeah. It's a truly intricate ecosystem.
And the alternative perspectives that we delved into, the concept of becoming your own bank through whole life insurance, and the strategic power of leveraging business credit for investment growth offers such compelling and empowering ways to think about managing our own financial lives.
Did you?
And accessing capital.
And here's where it gets really interesting for you, our listener. Yeah. Understanding these fundamental mechanisms isn't just about acquiring knowledge. Yeah. It's about gaining a deeper, more insightful awareness of how the financial world truly operates. This knowledge can empower you to identify potential opportunities and make more informed decisions about where you keep your money, how you borrow, and how you might strategically leverage different financial tools and systems to align with your personal and professional goals for that wealthy, good life.
Absolutely. And to continue exploring these concepts and discover even more valuable resources. Yes. Be sure to visit us at wealthygoodlife.com.
Yes. We also encourage you to share your thoughts and experiences. What resonated with you the most from our discussion today? Have you had any surprising or impactful experiences with banks? Or explored any of these alternative financial approaches? Head over to the comments section and let us know what stood out to you as the most significant takeaway from this deep dive.
And here's a final provocative thought for you to consider.
Okay.
In a financial world where banks generate profits from the constant flow of money, how can you strategically position yourself and your finances to benefit from that very flow rather than solely being a participant within it? It's a question worth pondering.
It is.
On your journey to building your own wealthy, good life.